Hey everyone, Jonathan Wells here, coming back with a actual new video series where I go over a week in review, looking over some key indicators, kind of giving you guys some ideas and things to look at when you're making investment decisions for yourself, or you're also looking at just the market news as a whole. Now, when I say investment news, I mean giving you guys some baseline information to then go review and research for yourself, as this is entirely for entertainment purposes only, and I want you guys to make sure you do your own research before you actually invest. So all the sources that I'm talking about today, I'm going to link in the description below. And if you guys have any further questions, please give me a comment because I can actually help you guys out here. I'd love to chat with you and help answer any questions you have. Now, before we get in the video, guys, make sure you go ahead and smash the like button. Please subscribe and turn the notification bells on as well. It greatly helps me out, and I really want to make sure I'm able to keep giving you guys this great content. As you can see through the rest of this video here, you're going to learn a lot of stuff, and there's going to be even more videos coming out after this explaining everything that we're talking about. So with this series, I'm filming these on every Saturday, and I'm going to be posting them on Sunday morning. That way you guys can see, what we need to look forward to in the new week and what we've been experiencing in the past week. So in order to make sure I provide the same consistent content for you guys, we're only going to be looking at a few key sectors that really influence the entire market as a whole. So today I'm throwing in a couple extra bonus ones, but any given week we should have 3 to 4 different sectors that we're looking at. So today's sectors are going to be the stock market, cryptocurrency, real estate, inflation, jobs, GDP, and then overall government regulation and policies. So while these 7 sectors look extremely different maybe to some people, they all kind of have things that intertwine everything together. Now, while somebody might say, oh, those are 7 different sectors, they don't really overlap at all. I'm not sure why we're talking about all of these. They actually do. So inflation is going to influence real estate prices, stock prices, cryptocurrencies. Also, government regulation could dictate where inflation is going to be over the next 3 to 6 months, or even further than that, based on how much they're spending, what kind of stimulus packages they're passing, and things like that as well. So again, a lot of these sectors are going to overlap, so you may be hearing me say things a couple different times, or pausing one area and going into the next area, and not fully explaining one particular item. So if you guys do have any future questions, please put those in the comments below, and I would love to help answer those for you guys and even make more videos on those too. So guys, without further ado, I'm going to go ahead and get into the video here. I'm going to look at GDP right now, which is going to be an actual representation of how much product we're creating in the US that we're then able to market to other countries and bring in more revenue with. I also want to go over the world economy and inflation in this portion as well. So first, guys, I want to talk about my source, which is the Kiplinger Letter. It's actually a letter that is for executives and investors alike that goes over a bunch of different sectors and breaks it all down on a week-by-week basis to really kind of piece together the whole economy and a lot of different market news. So according to the Kiplinger Letter, they stated that worldwide growth is actually going strong still, but our local GDP may have peaked for the year of 2021. They said that we're likely to post about a 6% gain. I believe we're at 5.4% right now. And it's a really big bounce back from the levels we were at during the illness. But what they're concerned about when it comes to actual overall worldwide economics and the local GDP is that in 2022, we're still going to have a lot of bottlenecked supply chains. And due to all the extra money that's running around, it's causing short-term prices on products to absolutely soar out the roof. And they're saying that rising inflation is squeezing businesses and individuals alike when it comes to food prices being up 33% year over year, according to the UN, and also that inflation is forcing central banks to increase their interest rates so that they can show investors that they're trying to put a lid on prices and keep everything relatively stable. Now, right now, it's mostly just the emerging markets that are having their central banks put a cap on everything, but likely we're going to see developing countries start to have to do this as well, which would mean that tighter credit is also going to come too. The US's GDP actually slowed to 2% in the third quarter, which is a far shot from the 6.7% that we had in the second quarter. Now, a lot of this was due to production shortages in auto manufacturing, and also new variants may have short-circuited plans for industries to get back to full capacity. But they're really expecting GDP to pick up in the fourth quarter, as you've seen a lot of new variants die down, and those people either have natural or boosted immunity. However, again, the supply shortage is really going to keep boosting prices up because we still have too many dollars chasing too few products. Also, the Kiplinger letter goes on to state that inflation will be 6% by the end of the year. And that will force places like the Federal Reserve to increase interest rates sometime in 2022. Speaking of inflation, I actually want to break down the latest report that we got in this week for you guys. It's called PCE, which is actually the Fed's favorite measure of inflation since it mostly correlates to what their actual monetary goals are. So how inflation reports work is that there is a 12-month report, and every new month we add on kicks off an old month. For example, we just got the report in for September of 21, so we just kicked off the report from September of 2020. So right now we actually replaced that September 2020 number with about 0.3% inflation for September of 2021. So that brought the headline report number to a whopping 4.2%, which is actually the hottest that report's been in the last 30 years. Now, the Fed's going to be meeting next week to talk about monetary policy, and I believe they're actually going to announce they're going to start tapering on securities, which is then going to make debt more expensive. So to actually break down what all of that meant, I'm actually going to upload a chart here from my good friend Dan Habib, and I'm going to break that down with you guys in a separate clip. So when I talk about tapering, I mean that the Fed is going to be reducing their purchases of securities. So on the top of the chart here, where it shows months, MBS, Treasuries, and total, MBS is going to stand for mortgage-backed securities. So that's how much in mortgage debt that the Fed is purchasing every month, and then the same for Treasuries, which shows their total securities purchases. So right now they're spending about $120 billion a month in MBS securities and Treasuries. So if they end up reducing their purchases over the next 6 to 7 months, we're actually going to see those numbers go down all the way to zero. They're only reducing their purchases by about $15 billion a month, so it's not shocking the economy like it has done in the past where we see a crazy stock market drop or anything like that. They're reducing their purchases slightly like this so that they can avoid any kind of major market changes. So my thought is that they're going to announce some version of tapering like this in their upcoming Fed meeting next week. And now what you guys may be thinking, well, what's driving all this inflation? It's really just the amount of money that the Fed has printed over the last 18 months. And combine that with bottleneck supply chains. The definition of inflation is too many dollars chasing too few products, and that's literally what's happening right now. And speaking of inflation, I want to actually go into some government policies that are coming out that may dictate how we see inflation over the next couple of years. Currently, Congress is getting closer to agreement on a $1.2 trillion, yes with a T, dollar infrastructure package, combined with a $1.75 trillion social spending package, with things like healthcare reform, childcare subsidies, clean energy provisions, and a lot more. Now, in this package, they're spending $555 billion on clean energy and climate reinvestments. Now, keep in mind, though, this is actually about half of the original proposal, which was $3 trillion, but a lot of current lawmakers are still very unhappy that their ideas are not getting through. So we may not even see this bill pass depending on who's going to actually give up what. And now let's get into the jobs report. So for all the jobs reports we've gotten for the month of September, we actually haven't seen as much growth as we would have liked to. Keep in mind, though, a lot of people are now just starting to return to the workforce since a lot of unemployment benefits ended in September. So we kind of expect to have a bigger job creation number here in the month of October, which we will actually get out in the BLS jobs report, which is going to be next Friday. Currently, right now, we're expecting about 400,000 job creations, but I'll keep you guys posted as that information comes out. Now let's get into my day job, which is the mortgage and real estate market. I've actually got a lot of information to break down for you guys here. So currently right now, with all the inflation concerns and the Fed's tapering concerns, we're actually going to see interest rates in the short term go ahead and move up. So that's also going to affect, some people's ability to purchase a home. And it could start putting a lid on home prices as they continue to rise, but at a slower pace. A lot of experts are still assuming that next year we're going to see 16% appreciation, but we're seeing expectations also on the lower end of appreciation. Now, a lot of times what the media is going to do is they're going to skew this number and tell you guys that since homes are now only appreciating by 3 or 4% a year, that we are nearing the peak of the housing bubble before it bursts. Now, in reality, being in the mortgage business, I know that the media would love to mislead you guys as often as they can. Realistically, it's actually very healthy that we see lower appreciation numbers, because think of it this way, it's like we're flying down the highway at 100 miles an hour, and then we see a state trooper and we go ahead and just ease back on the gas a little bit, and now we're going about 60 miles an hour. So we're still moving in the right direction, we're just not going as fast, which personally I think is actually healthy for the real estate market because you really can't sustain double-digit appreciation numbers for an extended period of time. Another thing to look at is that Imitation Homes, the actual largest landlord in the US, has reported that rents are up 18.5% and renewals are up over 8%. So in reality, it's not just a housing shortage on the new home side, it's really just a shortage in housing everywhere. So that's why I'm still very bullish on housing, and I think that we're going to see a lot of people get a lot of great returns on their home over the next 2 to 3 years, or potentially even longer. Now the last two things I want to get into is stocks and crypto. But right now we could be seeing the product bottlenecks start to actually affect businesses on their balance sheets. Places like Amazon are losing $2 billion a month in lost labor costs by having to reroute packages all over because they don't have the products. Now on top of that too, there's been a lot of bipartisan conversation on more regulation for bigger companies like Amazon. It uses their algorithm to find small businesses that are creating products. They will then go ahead and copy those products, list them on their site at a discount, take all of their customers, and then after they've put them out of business, then raise their prices. So you've seen a lot of bipartisan conversation on these particular cases, and it may come to hurt those businesses in the next couple of months or years. Okay guys, and our last conversation here is going to be on crypto. Currently, we've seen companies like Voyager Digital strike a marketing deal with the Dallas Mavericks. Also, some crypto industry experts are saying we could see another altcoin run as Bitcoin and Ethereum start hitting their all-time highs. So guys, if you're interested in more crypto stuff, I'm actually not the expert in that. I'm definitely going to link my friend's website you guys can check out and definitely do your own research on that. So guys, I hope you liked this week in a review, breaking down all these different sectors. A lot of them are going to overlap. Hopefully you got some good information out of this. Again, please drop me a like. And if this video was valuable for you guys, I'd love it if you shared with somebody else that you knew and encourage them to subscribe as well. So thank you guys so much. As always, I appreciate it, and I'll talk to you next time. Bye.